Welcome to Wash Talk, the Carwash Podcast. I'm your host, Rich DiPaolo, and welcoming in today, we have Reuven Birnkrant, CEO of PetroCal Associates. And this is, if I'm not mistaken, Reuven, this is your second time on Wash Talk, so welcome back. Thanks for joining me.
Thanks, Rich. It's great to be back with you.
Yeah, certainly. The last discussion we had, Reuven, was on ground leasing and following up with a great article that you put together for our magazine, Professional Carwashing and Detailing, back in the January 2024 issue. And then you were back at it again for December 2024. So you kind of bookend us here in 2024 with a great article on the topic of refinancing, right? And is it a good time to refinance for car wash operators, and what factors they should consider when going down that path? So I appreciate you writing another great article for us, Reuven, and I wanted to follow up and maybe go into a little bit of the weeds with some of those things that you mentioned in that article. Sounds good?
Yeah, it sounds good, Rich. I mean, as a PetroCal Associates, we're a boutique real estate finance and brokerage firm that specializes in car wash and gas station projects. So when it comes to all things real estate, when it comes to all things real estate finance, this is our bread and butter, and happy to share some of this information with your listeners.
All right, sounds good. So just spending some time with car wash operators over the years, and I'm sure it's the same for the discussions you have as well, Reuven, and just business owners in general. The two things that they seem to value most is time and money, right? So can you go over and obviously for the time portion, getting together with a solid bank and doing your due diligence and your preparation ahead of time, partnering with a good brokerage firm like PetroCal Associates can save them some time during the process, maybe even some money. So, but can you go over some of the costs associated with refinancing, and how business owners can determine, if it's quote unquote worth it for them to refinance?
Yeah, sure thing, Rich. So the costs associated with a refinance are the same costs associated with any commercial loan. You're going to include loan fees. If it's tied to real estate, there's going to be an appraisal, an environmental report, like a phase one, title charges from the title company, escrow charges. But then in addition to that, you might have prepayment penalties for the loan that you're paying off or refinancing. Some lenders will charge legal fees associated with document prep. And then on top of that, you end up resetting your amortization. So even though your monthly payment might go down, you might find yourself actually paying a little bit more interest than you were before the refinance. So it's important to take all of this into account before deciding whether to proceed with the refinance or putting it off.
Yeah, you mentioned that in your article, and I wanted to dive into that a little bit more. Can you explain how resetting the amortization during refinancing affects the business's long-term financial picture? And what should operators, are there any pitfalls or potential pitfalls that operators should avoid here?
Sure. So during the term of an amortizing mortgage, the percentage of your payment that is principal versus interest shifts. So in your first payment, more of the payment goes to interest than in your last payment. So if you refinance, you go back to a point in your loan where more of your payment is going to interest, which might not be to your advantage because less of your payment is then going to building equity and more of it is going to paying your lender. There are free amortization calculators available online, so you can compare your current loan to the new loan, or you can just ask the bank or a broker to provide an amortization schedule, which can help you determine if proceeding with the refinance makes sense.
Okay, understood. And they could find those calculators online just through a Google search, or is there? Okay.
But Google search, Excel has them preloaded. There's different ways to get there for sure.
Sounds good. All right. Appreciate that. So you and I scheduled this interview, and we're recording this interview. We scheduled it a few weeks back, Reuven. But just as we brilliantly planned, within the last hour, the Fed announced a third consecutive rate cut. I'm not sure if you caught that news yet, but it just broke not, within the hour of recording this interview here, this time by another quarter of a point. Potential rate cuts in store for 2025, maybe a little less than they predicted a few months ago, but still, we're looking at fluctuating interest rates, Reuven, and with the prediction of future rate cuts. Which strategies can car wash operators use to determine, the best timing maybe to refinance a loan?
Yeah. It's funny. Our timing really couldn't have been much better in that regard. So as you mentioned, the Fed did cut rates today by 0.25%, but they also suggested they're going to be more cautious with future rate cuts, indicating there might only be another 0.5% of cuts by the end of 2025. And it's important to remember that just deals with the Fed funds rate, which does correlate with the Wall Street Journal prime rate. But there are other indexes that loans can be tied to. And so if you look at treasuries, for example, those are actually up notably in the last 90 days since the Fed began cutting rates in September. So one thing operators can do is just do your homework and generally understand where rates are. If you look more broadly, yes, rates are expected to fall slightly more relative to where they are today, but not significantly. Um, Prime is essentially in the same place today where it was for much of 2006, 2007. Treasuries are actually slightly below where they were for much of those years. And recent economic data suggests that the labor market is actually relatively healthy and inflation is a little stickier than the Fed would like. So this suggests that rates aren't necessarily going to fall a ton over the short to medium term unless the economy weakens significantly. So really the point is you can't time the market, right? So what it really comes down to is the motivation for the refinance. If you've made the decision to expand and you need to pull cash out of an existing car wash you operate or property you own, you might want to start on a refinance even before you found the expansion site. That way you have the cash available for a down payment when you actually find the site. You might have a balloon payment coming up on your existing loan in 2025 or 2026, so you're going to have to refinance. Or you took out your loan in 2023 when rates are a little higher, and now your payment has come. So your prepayment penalty today has maybe come down some relative to where it was at the beginning, and so now there becomes a little more of a business case for doing a refinance now. So again, it's really just about the right reasons and less about timing the market perfectly. If the reasons make sense, then now can be as good a time as any, as opposed to waiting.
And just like, anybody who wants to take a personal loan, if I want to go out there and take a loan for a car or something, the lender is going to want to know what my debt to salary income ratio is, what's my current, all these things, and business owners aren't exempt from that scrutiny as well, right, Reuven? So how can car wash operators demonstrate to lenders that their businesses have a solid trajectory for growth, even if maybe financial performance in recent years have been impacted by, let's say, external broader market challenges?
Yeah, it's a great question, Rich. I mean, look, rarely is the whole picture rosy, and that's okay. Just be prepared to highlight the positives in the company and to provide explanations for some of the negatives and why those things might turn around. Maybe wash volumes are down, but average ticket is up. Even if revenues have dipped a little bit recently, highlight the stability of the membership revenue over the last few years, which provides an ability to weather some of the ups and downs. It's important to provide context around some negative trends. Speaking of weather, many parts of the country had some funky weather at some points over the last few years. Don't hesitate to give the lender that background. It's particularly relevant if the negative trend is due to something non-recurring. Let's say there's road construction near your site that impacted your customers' typical travel patterns. A lender would be willing to accept that when the construction ends, business will likely pick up and return to a more normal pace. One thing you can always do is provide projections with reasonable and supportable assumptions that demonstrate the business's ability to repay the loan that you're applying for.
You mentioned in a previous answer during this interview, and maybe some of the other reasons that operators might want to consider a refinance play outside of simply just reducing payments, right? You made maybe a balloon payments coming up, or you mentioned some of this stuff in the article as well. Reasons to refinance just beyond reducing payments. Such as simplifying debt structure and improving loan terms. Can you give specific examples of how these strategies have benefited car wash operators that you've been experienced with?
Yeah, sure. I mean, with regard to simplifying debt structures, we've seen operators with loans from three, four, five, even 10 lenders. And each loan has its own reporting requirement and lender that you got to keep up to date. Sending documents to all these different lenders can be a pain, candidly. I mean, if an operator refinances all those loans with one lender, it could just make reporting much easier. We've helped borrowers refinance portfolios of 11 loans on 11 sites into one large loan, which then just simplified things for the operator immensely. Um, the added benefit of refinancing multiple loans with one lender is from an equity perspective, on its own, each single site might not have enough equity to warrant a cash out refinance or a line of credit. But if pulled together, there might be enough equity to obtain a line of credit that can then be used for expansion. Another example of improving loan terms without necessarily reducing monthly payment would be refinancing a recourse loan or one that's personally guaranteed with a non-recourse loan, thereby eliminating the personal guarantee. Um, Another reason that borrower might want to seek a refinance, like you mentioned, is if a loan has a balloon payment that's coming up and they're not prepared to pay off the loan in full, then they'll have to do a refinance. One thing we typically encounter with a lot of our newer operators is they might want to refinance an SBA loan with a conventional loan in order to free up SBA eligibility, because SBA sets a cap on the amount of SBA debt each borrower can have out. So we've helped borrowers refinance an SBA loan that they used to build their first location into a conventional loan. So that way they have no outstanding SBA debt. And then they can use the SBA loan to build the next project. So as you can see, there are many reasons why a borrower would seek a refinance beyond just reducing monthly payments.
Very interesting. Interesting. So as a follow up, if I'm an established business with significant equity, what are the potential benefits and risks of something you just mentioned, a cash out refinance, and how should operators best evaluate their options?
Yeah. I mean, the primary benefit is just access to more capital without having to bring on investors or sell. Plus, the receipt of this capital isn't a taxable event. Now, some lenders will allow the capital to be used to pay dividends or to distribute it to shareholders, while others will put some restrictions on how cash out proceeds can be used and might want to see them earmarked for expansion. Naturally, the risk is that, you're usually burdening a cash flowing asset with higher debt, which then just absorb more of the cash flow of the business. And it's important to know that even if there's adequate equity for a cash out refinance, a lender will still need to see that there is adequate cash flow to support the higher debt load.
Interesting. Yeah, Reuven, I've been doing these interviews for a while, and one thing I noticed is that just as important as it is to know the best practices, it's also important, just as important to know what not to do, right? What common mistakes that are being made, and you've certainly gone through that through your article that you wrote for us. And again, I don't know if I mentioned it before, but if those listening and watching this video now, if they haven't had a chance to head to carwash.com and read your article, we have it in our digital edition, and we'll have it posted on its own at carwash.com soon enough. So implore our listeners to go read that article. But yeah, what key indicators should car wash owners monitor to decide when to refinance? And are there any common mistakes that you've noticed people making that they should maybe avoid during this process?
Sure. Yeah. I mean, look, first things first, operators should be aware of the terms of their existing loan. This way they know the costs associated with getting out of their existing loan. Someone could have taken the loan out in 2021 and feel like they can get a lower rate today. But if their existing loan is on a 5-year fixed and the rate is about to adjust in the next 12 months or so to current rates, it might not make sense to do a refinance today and incur all the costs associated with that. Um, Operators should also be aware of prepayment penalties on their existing loans, as those have the potential to offset some of the benefit of refinancing. I mean, we've seen loans with resetting prepayment penalties. So, for example, it's like a 10-year loan that is fixed for 5 years. Then after 5 years, it reprices and fixes for another 5 years. But the prepayment penalty also resets when the rate refixes. So it goes from 5, 4, 3, 2, 1 in the first 5 years, and then resets in year 6, and then starts up again at 5, 4, 3, 2, 1. So if you refinance in year 7, you might be hit with a 4% prepayment penalty, which on a $5 million loan is $200,000. So that might not necessarily be the best time to refinance. Operators should also be cognizant of the trends their business has experienced over the last few years and consider whether their loan request is likely to be approved. It's understandable why an operator would want to lower their rate, but if the business is in a downward trend, it might be difficult to find a lender who'd be willing to help them out. Operators should be aware of potential upcoming balloon payments, so they aren't in a pinch as they approach loan maturity. I would say a common mistake that we see from operators is that they'll just start the refinance process too late. They'll figure, hey, this is a established business, it's cash flowing, so this should be really quick. But the reality is lenders are taking longer with everything today than they used to. Even on simple refinances, they're still doing thorough due diligence. Plus, you have to get an appraisal, which takes about 30 days. You probably have to do an environmental report. That takes time. And you never know how long it's going to take for your bookkeeper to produce financials. If your maturity date for your loan happens to coincide around tax season, your CPA might not be able to turn things around as quickly as you'd like them to. So if you have a loan that's coming up on maturity, we always tell clients it's best to start at least 4 to 6 months in advance so you have plenty of time to get it done.
All right, sounds good. Well, it sounds like refinancing could be a game-changing strategy in certain situations, but it sounds like there's some circumstances where refinancing is not ideal. Correct, Reuven?
Sure. I mean, look, the rates have been high the last couple of years. And so if you took the loan out very recently, it might be appealing the idea of getting a lower rate, but it might not make sense to refinance given the cost of the appraisal, the environmental, title, loan fees, prepayment penalty, etc. Could end up offsetting a good chunk of the benefits. And usually prepayment penalties do decline over time, so it might just make sense to wait a little bit more before going ahead with that. Also, if you're planning on selling in the not too distant future, it might not make sense either because you incur the fees and costs up front, and you don't really see the benefit of the lower payments until some time has passed. Think about it this way. If the refinance saves you $2,000 a month, but the costs, when they're all totaled together, come to around $50,000, you don't really realize the benefit of the refinance until you're 25 months into the new loan. So typically, refinancing is best if you intend to hold on to the asset for a while longer, or if you want to pull cash out to expand or something like that. When most people think of refinances, they think of lowering their rate and lowering their payments. But that's only part of the picture. There are costs associated with refinancing that need to be taken into account to determine when you really start to realize the benefit of the refinance. If you don't hold the loan for a couple of years after you refi, the cost might outweigh the benefit. It's also important to remember there are reasons to refinance outside of lowering your rate and payment, like we talked about leveraging equity and pulling cash out for expansion, consolidating loans across multiple sites, freeing up SBA eligibility, just to name a few. So we try to take a holistic view of our borrowers to understand what their short-term, long-term needs and goals are in order to put in place debt that best positions them to achieve what they want to long-term. So at PetroCal Associates, we help them understand the pluses and minuses and the potential options before they start on this path. And then with this approach, sometimes it makes sense to hold off on a refinance until circumstances better support it. And sometimes it makes sense to go for it now even if you think rates are still going to drop a little bit more over the coming months or even years.
Yeah, I love how you started your article about is now a great time to refinance? If not now, when? And your answer was it depends, right? So it's more than meets the eye when it comes to refinancing, which is why it's so important to get with a broker and a responsible bank that's going to help you along the way. You want to give out your website, Reuven, for us, or a phone number where folks could reach out if they're interested in going down this path with you?
Yeah, absolutely. Website is www.petrocalassociates.com. And there's a contact us page on the website. And if that gets filled out, we'll immediately get in touch with you within 24 hours. And look, when it's all said and done, I think a lot of operators have been waiting for the stars to align to make the business case to go do a refinance. And things are starting to align for that. I mean, that's certainly the case more broadly. So, um, if you're interested in exploring whether now is the right time or not, um, reach out to us. We have a no cost consultation and can kind of walk through some of the options that would potentially be available to you, understand the specifics of your situation, and then collaboratively make the determination as to what's the best path for you.
Oh, well, I know time is money, just going back to two of those important things. And you certainly have taken a lot of time, in 2024, Reuven, writing these two great articles for us and then following up with these podcast interviews. I can't thank you enough. I know this probably won't get on the website until 2025, early, January, early 2025, but you're taking some time right here before the holiday break. And I wish you, happy holidays, and I hope you have a great new year. And thanks for taking some time with me today, Reuven.
Absolutely. Same to you, Reg. Looking forward to seeing more of each other in 2025.
Sounds good, bud. All right.